Thank you everybody for joining today. We're going to get started here shortly. We're going to give a couple people a couple more minutes to get into the webinar. We'll be with you here shortly. Thank you. All right, ladies and gentlemen, we're going to get started today. First of all, I wanted to thank everybody for joining us on our webinar, Planning for Your Retirement in Today's Market, presented by myself, Joshua Stipcich. I'm one of the managing partners here at Tidemark Financial Partners. And I brought along one of our other senior advisors, Frank Alvarez, to join us. And we're going to go through 4 different strategies that individuals should be doing today when it comes to planning for retirement in today's market. And we've had a lot of clients and a lot of prospects ask a lot of different questions on what they should be doing besides obviously continuing to save for that ultimate goal of retirement. What are some other strategies that they should be looking at? And we want to make sure that we start sharing it with everybody. So, if you do have questions along the way, please email us info@tidemarkfp.com. Once again, that's info@tidemarkfp.com. Also, we're going to be sending out everybody that signed up for this an ebook that we put together. How do you master the 401k? Along with the first 15 individuals that are looking for a consultation, We're going to give them a full financial plan, which includes retirement planning and investment analysis, cash flow, and a number of other things inside of there as well too. So if you're interested in any of that, email us info@tidemarkfp.com. So a little bit about us. Who is Tidemark Financial? Our office is located right here in San Diego in Sereno Valley. Between the advisors that are in our office, we offer over 50 years of combined experience providing retirement planning and investment management, not only to individuals, but also to businesses as well. Really our specialty is the retirees, people that are getting close to retirement or already in retirement and worried about making sure that their plan is going to continue to work along the way. And ultimately, are they able to live the lifestyle that they want to do? Other things, obviously the investment review and investment management, educational workshops and seminars and webinars such as this. But really our strength is working with families one-on-one and getting that personal relationship about what it is that we go through and do. So let's talk about today's agenda. Really we're talking about preparing for retirement, right? And, whether you're 5, 10, or even 15 years away from retirement, we start to call this the retirement red zone. And what is the retirement red zone is really understanding what is it that you can do for retirement? How do you budget for that? Not only budgeting today when it comes from cash flow, but, just because you retire doesn't mean that you don't have a budget anymore. Where does income start to come from? You have 401ks, IRAs, we may have annuities, Social Security, possibly pensions. How does the income stream going to look like? And what is it that you actually go through and do? How often should you review your current portfolio? And what does that actually look like? Are you taking too much risk? Are you not taking enough risk? Determining exactly what that is. And then last but not least, we're going to be talking about what are those 4 strategies that that you should be looking at least in today's market. So budgeting for retirement. Hopefully everybody that's joining us today has a budget in place already and has started to think about what is my budget going to look like for retirement? How much income am I going to want to replace when I get to that ultimate goal of retirement? And, an interesting study that we saw through Fidelity was talking about, the income that you're making now, how does it differentiate yourselves from when you get to retirement, and how much are you actually having to replace, and how much of that replacement is really coming from Social Security? So you can see if you're kind of in that, the lower income bucket of, around $50,000, 35% of your total income replacement will come from your Social Security. The other 45% should be coming from savings. So that's things such as your 401ks, IRAs, and other investment accounts that are there. So really, you're looking at replacing about 80% of your total income. Now, as you start to make more money, the total amount of income that needs to be replaced starts to reduce. So as you get into that $100,000, you're going down to 72%, 200,000, 61, and 300,000 is 55. And I think this is kind of, this is very important because you want to understand of how much income do I actually need to replace when I get to retirement. Now, this is obviously just a kind of a study and a guideline. Everybody's situation is a little bit different. And, when we talk about budgeting, we say, all right, what is it that I can do now? How can I start preparing for retirement, especially if you're in that 2 to 3 year window away from actually being able to retire? What are some of the things that I can do now? And one of the big areas that we suggest is to say, hey, if I make $150,000 today, but I can live off of $100,000 when I retire, start implementing those areas now. What this will allow you to do is to realize, is that goal an actual expectation set? And do you accomplish it? Can you really live off of $100,000? The other great thing that this will do is this will help you continue to save more money. And when you're looking at your budget, what are some of the different things that you can look at? Now, one, we all have fixed expenses. We need a roof over our head. We need to make sure that we have food on the table. These are things that we need day in and day out, no matter what happens. Really, where retirees and even individuals that aren't retired have the biggest trouble with is those variable expenses. Going out to dinners, going out to movies, going out to these different events, golfing, whatever it is that somebody has for their hobbies. It's not stuff that we necessarily need, but it's what we want. And so it's starting to figure out what are those 2 things and how can that work? I look at it a lot of times when we talk to clients is they don't know necessarily how much money they're going to need for retirement. They don't know where they are. And that's part of the reasons why a lot of people come to us is understanding what those things are of what is that number I need to get to. But before we start talking about those numbers, what we need to start looking at is where is our income going to come from? And, I think that the bench idea, which has 3 pillars, is a great way to kind of think about my income. One, some money will come from Social Security. Now, obviously, that is, Social Security is a hot topic, and we'll save that for another webinar. But that is something that a lot of people rely on. 2 is pensions. Unfortunately, pensions today are starting to become less and less popular for employers to offer to the employees, and are also starting to say, hey, we'll buy out these pensions from you and give you a larger lump sum to make sure that they're not on the books for having to pay you for the rest of your life. And really that leads into the last one, which is where you have a lot of control, is your IRAs, 401ks, and other investment tools. Is we have how much control of how much money somebody can save. We have control as far as where that money gets invested. We have that access, and that's really where today a lot of employers and even the government and those different areas are starting to lean more pressure on to make sure that they can make their own destiny. And so, understanding these 3 areas is something that's extremely important. Now, we talked about when it comes to budgeting, your fixed income versus your variable, your fixed expenses versus your variable expenses, right? Well, the same thing comes with our income as far as where it's going to come from. Our fixed assets, paychecks that we know we're going to get month in and month out, are going to come from our pension and our Social Security. So is that enough to cover your fixed expenses that's there? The IRAs, both Roth, traditional, 401k plans, amongst other assets, will be those variables. So that'll be like, hey, we want to go on an annual trip. We want to be able to golf. We want to be able to go see our grandkids in a different state, do these different things. That is stuff that is variable that we don't necessarily need to have to rely on, but it's more of our wants once again. And so how do you find the balance between the 2 that are there? And, as we're doing a lot of retirement planning for individuals, they say, all right, well, where's my money going to come from? How does this actually look when it talks about my overall retirement plan? And so what we wanted to show you as a hypothetical example is, breaking down the 2 of how does pension, Social Security, how do we maximize both of those with the assets that are there? And what this illustration will show you is the amount of income in the beginning years, which is, all right, we're just relying on a pension that's there because we want to maximize Social Security. You can see here around year 2026, 2027 is where now these individuals, this husband and wife, are starting to turn on their Social Security because we're maximizing what's happening. They're able to live off of that for about 20 years. And then unfortunately, one of the spouses dies where the pension is no longer going to pay out to the other individual. And that's where it's very important to make sure you have those 401ks, those IRAs, and those other investments for those what if and those when they time happen scenarios. And so this just gives you a brief idea of where we're actually at for our living expenses. Now, as we start to go through this presentation and the webinar, I want to make sure that people do email us info@tidemarkfp.com if they do have questions. And we'll definitely be emailing you throughout this webinar as well too. I just wanted to make sure that everybody knows that. So one of the things of how do we determine if our financial plan is successful is looking at a Monte Carlo simulation. A lot of individuals have never heard of Monte Carlo before. They don't know exactly what it is. And what it does is it runs 1,000 different trials as far as what the market would do from the best case to the worst case. And it will tell us what is the percentage of chance of this plan, this retirement plan, actually working. And we're kind of building on to what the illustration from below is. This couple had a 77% chance of their financial plan, their retirement plan working. And so, as we work with clients and as we work with future clients, the question starts to become, Are they comfortable with that? And if they're not, what are the things that we can change, that we can control? We can control the amount of income that somebody lives on. We can control the amount of money that somebody is saving. Those are two of the big things that we can control. We can't necessarily control our health, obviously, because we don't know those types of scenarios. We don't know the day that we're going to pass away or our spouse is going to pass away. But we want to look at, all right, how much money extra do I need to save on a monthly basis to reach this goal? Or how much less income do I need to live off when we get to retirement? And the Monte Carlo is so important because I think about it this way, saying, hey, ladies and gentlemen, thank you for flying Tidemark Financial Air. We have a 63% chance of getting to our destination. The question that I ask you is, would you get on that plane? For a 63% chance, would you get on that plane? Or would you want to start looking at what other options can you do to get to that destination to make that number higher? And this is something that is extremely important when it comes to planning, is what is it that I can do now to change the next 2, 5, 10, or 15 years of my retirement planning to make sure that it is more successful. One of the biggest things that people want to know about is asset allocation. And I think Ray Dalio, who I look up as one of the top, investors, money managers that are out there, he says, I think that the first thing is you should have a strategic asset allocation mix that assumes that we don't know what the future is going to hold. And this is so important when we look at the history of the stock market, we look at the history of the bond market, both on the US and the foreign side, is we don't know necessarily what's going to happen tomorrow. A lot of people never predicted the tech bubble in the late 90s, early 2000s. 2008, people didn't necessarily predict, as far as from a majority of what was going to happen with the financial crisis. Even in today's market, there's just no predictions that we know that we can't control. And so that's why asset allocation is so important. And when we look at asset allocation and are we taking enough risk? Are we taking too much risk? What is the case? The way that we look at it is we start to stress test and actually put a risk score towards our clients' accounts. Once again, here's a hypothetical that shows you they got a personal trust, a traditional IRA, and a Roth IRA. And each one should have a different type of risk score depending on when somebody needs that money. And is the right areas in place? And so, for example, with this individual, we started looking at their personal trust and they said, hey, this is our most conservative account because this is money that we're going to need in the next year or two. Well, we started breaking it down, and this was actually the most aggressive portfolio that they had between their 3 accounts. And so it's looking at, okay, why is that? What investments are inside of there? And what is it, if something were to happen in the markets, what exactly would happen with their actual allocation of their monies? So we go back, we say, all right, well, in 2008, which was, the bear market, we had the Great Recession, which was from the end of 2007 to the beginning of 2009. And then the bull market, which was, 2013. How would our current accounts have reacted versus the proposed allocations that we were looking at? And we look at the bear market, we're talking a difference of, almost $65,000 that they potentially could have not lost if they had the right asset allocation when it comes to it. Now, this is not obviously saying this would be the same for everybody, but I think risk is an important conversation that a lot of people don't have. They don't necessarily understand. And so as we continue to work with clients and prospects, we continue to want to stress test these portfolios so we understand the risk that individuals are exposed to. We talked a lot about retirement planning and everything else that was coming there. And, once again, I want to introduce Frank Alvarez here. And he's going to talk about what are the 4 strategies that individuals can start doing today to start taking action to take control of their retirement plan. And that's something that I think is really important, is it's now important for us as a society is to take advantage and to take control of what you do when it comes to retirement planning. So, Frank, I want to first thank you for taking time out of your day and to share some of this knowledge with individuals on what are some of the strategies that they can do to take advantage of today's market.
Thank you so much. Sorry. Thank you so much, Josh. So once again, for everybody who doesn't know me, I'm Frank Alvarez, and I'm a financial consultant here at Tidemark Financial Partners. And really the reason Josh brought me to speak about these 4 strategies is because, and really the reason why we wanted to start this webinar once again, is because we started getting people calling our office and asking us, the market is volatile right now. What can I do? Can I take advantage of this opportunity? Is the market gonna keep on crashing? So our team really sat down, and Josh and I sat down, and we started looking at the 4 things that we started doing for some of our clients. I will want to be sharing some of those strategies with you tonight. So really, let's go ahead and get started over here. So really, what can I do right now? All right. So basically, this is going to be the 4 things we're going to talk a little bit more in detail today. The first thing we're going to talk about is going to be the review your current asset allocation. I think Josh did a fantastic job with this. And I can't emphasize enough, really, the importance about having a written financial plan. This is really going to give you that peace of mind of knowing exactly year by year what your cash flow looks like, what risk is important for you. And the reason I say this, or why is it important, is because what we found out too as well is a lot of people don't get interested or stop being interested about their investment allocation and such if the risk is pretty high. So what we start seeing is younger couples sometimes take a look at their asset allocation and seeing the big drops within the market, and they get panicked, right? And they stop investing and they focus on more conservative investments, when actually by doing this, the strategy is going to take a lot longer in order for them to accomplish their goal. So educating yourself on the proper risk score, stress testing your portfolio, doing those Monte Carlos gives you that peace of mind of knowing exactly where you are, where you need to be. And it's something that you can review year over year to see how you're liking it. Is retirement sustainable? Is your lifestyle sustainable? So once again, I think that Josh did a fantastic job. And for everybody that just tuning in right now, stick towards the end, because we're going to send you a link for the webinar replay so you can see what Josh talked about this specific topic. Next thing that we're going to talk about is going to be taking control over your assets. So what we found here is for a majority of people, their biggest or largest liquid assets fall within retirement accounts. So we're going to be focusing a lot on traditional IRAs, 401ks, Roth IRAs, etc. So basically, let's talk about traditional 401k accounts and IRAs, right? And this is where the account consolidation comes into play. Account consolidation, basically what it means is, what we also found out in this study is that for a lot of people, they work an average of between 5 to 7 different jobs throughout their lifetime before reaching to that last job, right? So maybe you're one of those people who started working somewhere when you were 18 and definitely have changed different jobs all the way until the current position that you're at right now. What's recommended is for people to start opening up their 401ks. But what a lot of people don't know is that once they open up their 401k accounts, they just leave them there, right? So we like to use this analogy with prospective clients. It's basically like saying, okay, I started this new position and I have my desk, I have my pictures, I have everything, and I have a briefcase down my desk. Every single paycheck that I'm getting, I'm putting a little bit of money away into that briefcase. Guess what happens when you leave that employer? Basically, you take your pictures, you take your plans, you take everything. But what a lot of people do is they forget about that briefcase underneath that desk. Now, this basically, what the employer guarantees is that the briefcase is going to be safe with them. But if you want to get access to that briefcase of money, you have to go through the employer-sponsored 401k plan provider. So a couple of cons that comes down with this is, one of them is you don't have complete control over that money because it's still with that old employer 401k plan. Now that old employer 401k could change, right? An employer can change 401k providers whenever they feel like it. So basically you don't have control over what investments do you have. And if you forget your password, you need to contact HR and do that whole different process, 1-800 number, etc. Right? So this can create a disadvantage for you to take control over that money. What a lot of people don't know is that we can grab the portfolio, we can grab the briefcase of money and move it over into your new employer 401k plan. But you also have the option of moving it over to what's called a traditional IRA. So a traditional IRA, basically what it is an individual retirement account. What it is it's a tax-deferred account. So because we're moving it from tax-deferred account A, which is your 401k plan, into tax-deferred account B, which is your traditional IRA, there's no penalty, there's no taxes, nothing involved with it. Really, this gives you the advantage of opening up a platform of investments. And the big thing is that now the money is invested or the money is registered under your own individual name. So by having all the accounts consolidated, the big advantage about this is that now we can take a look at your retirement assets as a whole and make sure that we're doing proper diversification of those by not having to sign into different accounts and knowing what percentage of assets you have in each category. So it's going to give you that big control. Next thing that we're going to talk a little bit more in detail is what we call in-service withdrawals. This is basically withdrawing money from your 401k while still working. The big caveat here is you have to be 59 and a half in order for you to do so. And this gives you the advantage of moving the assets from that 401k into a traditional IRA. And we're going to talk about a little bit about the pros and cons of doing this. Next thing that we're going to talk about is going to be tax loss harvesting, which is how to take advantage of the opportunities the IRS is giving you when it comes down to the tax code to possibly help you with taxes during volatile times. Lastly, we're going to talk about is going to be Roth conversions, which is how can we increase our tax-free income during volatile times. So as I mentioned, let's go ahead and talk a little bit more about in-service withdrawals, right? So what is an in-service distribution? Well, quite simply, it is a distribution that a participant takes from a retirement plan while they're still employed. Are there any restrictions as to when a participant can take an in-service distribution? Yes, we talked about it. For a lot of those, restrictions is age, right? And what source or what account source this is coming from. It can be your employee deferrals, any profit sharing plans, the 401ks, etc. So those restrictions are generally based on factors such as age and service. So what is the significance of age 59 and a half when it comes down to in-service distributions? So this is going to be the earliest age that allows a participant to take an in-service distribution from his or her 401k. Coincidentally, this age, the 59 and a half, probably you've heard it before. And this is the earliest age that you can withdraw assets from retirement accounts without incurring the 10% early tax penalty. So a quick example that I can think about this is a current client that we've been working with for a couple of years. And usually we like to sit down with clients at the beginning of the year to start planning for that year. And the client expressed concern about his assets since the market in 2019 had done pretty well and 2020 was shaping to be a pretty awesome year. And he was a little concerned about his assets. So we took a look at the 401k plan, and within the 401k plan, which is the case for most 401k plans, that particular provider only showed the ability for the participant to invest in anywhere between 5 and 10 funds. Majority of those funds were what we call age-based funds. And when we took a look at the fund options that the participant had, we found out that he only had 2 bond funds. And they were pretty generic funds. They were okay funds. But in order for the participant to lower the risk in his portfolio, he was just not giving that advantage of looking into more investments that could potentially help conserve the portfolio a little bit longer. So what we did is the client was 60 years old. What we did is we transferred those assets from that 401k into an IRA that he already had open where he had consolidated all his accounts. And then therefore the investment platform really opened up and we started looking into gold, for example, different types of bonds and all these different investments that could potentially lower the risk for his portfolio. Weirdly enough, this whole situation happened and the market actually took a pretty big dive and the client was really happy that those options were available for him where he could take advantage of some of these opportunities. That's why we feel it's very important to have this in-service withdrawal strategy into your playbook. So this is basically a quick example here of what it looks like. This is for a Fidelity plan. This was for a client. One thing to point out is that you can do either a partial withdrawal or a full withdrawal, depending on what your needs are with the 401k, right? So Roth conversions. Since we're talking about retirement accounts, right? Really, this next strategy is really important. This is the potential to transfer assets from a lower value from a pre-tax account. So pre-tax account are gonna be your 401ks, your traditional IRAs, into a post-tax account. This is gonna give you that potential to increase your tax-free growth on recovery. So a quick example of this would be this, right? Let's say that you own Apple stock, and Apple stock is trading at $100 per share, but you really like Apple and you're gonna hold it no matter what. So if Apple drops down to $50 per share, this is a hypothetical example. Now your shares are worth a lot less. You have the opportunity to convert those assets from the pre-tax account, from the IRAs that you had, from those 401ks, and roll them over or convert them into a post-tax account such as the Roth IRA account. The advantage of post-tax accounts such as Roth IRA accounts is that they grow tax-free. So if you think that Apple is going to recover from $50 a share back to $100 a share and even more, then by doing this transaction, we're capturing that gain now on tax-free money and tax-free income. Something to point out by doing this is we're triggering ordinary income taxes by doing so. So make sure that you consult with your CPA or a financial professional such as ourselves before attempting to do so. But it can drastically help you out, increase the tax income, the tax-free income. So another advantage about having a Roth IRA is it has the potential to reduce RMDs. So RMDs are required minimum distributions that you're forced to take at age 72, whether you need that money or not from your pre-tax accounts. Roth IRA accounts don't go into that category. So once again, we want to make sure that you talk to your financial advisor and tax professional before attempting any of these. So Josh, anything you want to add into these two categories?
Yeah, I think that, let me get my video back on here. I think that obviously the in-service withdrawals and the Roth conversions are extremely important for people at least just to look at. Is looking at, if you need money in the next couple of years, the Roth conversion may not make sense. But if you think about like having money in different buckets or different timeframes of when you're actually going to need it, and as Frank kind of alluded to, saying like Apple, if I know I'm going to hold Apple for the next 10 or 15 years before I'm willing to sell that off for any gains, is looking at, right, what is the tax consequence that I'm going to have to hit for this year? And what is my break-even point when it comes to that? And the other big thing I think with like the in-service withdrawals is really taking control of your assets. A lot of you have worked for 20 plus years, 30 plus years, and you've gone from employer to employer account. And now it's important for you to take control and say, hey, I want to make sure that I can do what I feel is in the best interest of my own money, and not necessarily have the Fidelities or these other types of companies that are out there with your employer just kind of picking that fun lineup like Frank was saying. Those two strategies as far as the Roth conversions and the in-service withdrawals are some of the least talked about for individuals. And
specifically right now, I can think of top of my mind a couple of clients reaching out and saying, I believe that cloud computing is going to be the next thing when pandemic was hitting. And unfortunately, within their 401ks, they just offer a large cap fund, mid cap, small cap, and as usual. And by having that control, it does allow you to pick individual sectors if that's something that you're looking for, or that's something that you want to take advantage for. And like I mentioned with my clients, it was something where the bond fund, it was a pretty generic bond fund. It was pretty generic. It was not broken down into the different time frames that a bond fund should have. So it really limit us to what can we do to limit the downside. And therefore, the reason that the IRS does allow pre-retirees or retirees at 59 and a half to do this strategy, because they recognize that some 401k providers do not offer enough tools for them to be a lot more conservative.
Well, and I also think that really quick before we get on to this next topic is the reason behind 401ks is meant as a savings tool. right?
Correct.
It's meant for individuals to be able to save the money to be able to fund their retirement, which is fantastic. The thing that gets lost is as they get into, and this is why that 59 and a half age and even the in-service withdrawal has been put into place, is it then allows you to preserve those assets. You know, there's the accumulation phase, which a lot of people do from, hopefully, knock on wood, their early 20s when they get their first job till they get into their, you know, their 40s and 50s. Now you need to protect that money that you've worked so hard with over there. And, you know, this next thing I think is important because just saving in a 401k or IRAs or Roth IRA, whatever the case is great. But a lot of people also save outside of the retirement accounts. They may have investment accounts that are more liquid. And, you know, that is a huge thing that people could look at today. And I'm going to have Franco through what is tax loss harvesting, right?
Yeah.
I'd say 9 out of 10 people that we talk to don't do anything. They're just like, yep, I'm going to hold it and I'm going to hold it forever, no matter what it does. And that's the strategy that I think a lot of people need to look at and take advantage of is tax loss harvesting.
Yeah, and this is 9 out of the 10 people who actually did save out of retirement accounts. What we found is a lot of people are not saving for those midterm goals. Even if you haven't reached that age 59 and a half, there's still things that you want to accomplish in life, such as buying that second property, taking that big vacation with your family, helping your grandkids, helping your kids purchase their first home. And this is where this investment account is so important, yet a lot of people are just investing in their retirement accounts. And they say, well, investments is in my 401k, but that's it. And few people do understand that, and they do have investment accounts that are outside of 401k plans. And this strategy is for those people who do have it or who are about to start saving for this. So basically, tax loss harvesting is taking advantage of the rules that the IRS and the tax code is giving us, right? So basically, the IRS, the way that the IRS sees your income is this: if you make money, you pay me taxes, right? If you lose money, there's a couple of ways that I can help you get a pardon for paying those taxes, right? So this is where the concept of short-term capital gains and long-term capital gains, short-term capital losses, etc., comes into play. Right. So basically what it is the IRS, if you have any sort of account that is outside of retirement accounts and you incur a loss on that specific investment, then that could be tax deductible up to $3,000 to offset your ordinary income, or you can offset any gains that you do while rebalancing your accounts, right? So basically it's investment losses that can help you reduce taxes by offsetting gains or income. Even if you don't have any gains, there are benefits to harvesting losses now, since they can be used to offset income or future gains. And like I mentioned, if you have capital losses, if you have more capital losses than gains, you can use up to $3,000 a year to offset ordinary income on federal income taxes, and you can carry over any of those losses for future years. So something to take a look at is you should rebalance your portfolio every single year. Why is this? Because some specific sectors are going to perform better than others, and you don't want to be overweight in the specific sectors. So a great way when markets are volatile is for you to take a look at that set portfolio, do the rebalancing, take a look at what are your gainers, what are some of your losers, can you offset that income by selling some of those losers and rebalancing those gainers. And even if you don't have any gains, by switching investments, and it doesn't have to be necessarily something completely outside of what you had. Basically what it means is if you had a Fidelity account, large cap fund, for example, and that one depreciated in value, you have a loss, then we sell it, we realize that loss, and we switch it for a Vanguard large cap fund, something that is similar, but it's a different investment company. Now we're still in the same sector. However, we realize that loss that is going to help us with taxes. So this is something to take a look at, especially during volatile times, that can potentially help you generate that tax alpha, that extra tax boost within your year. Once again, just like with the previous strategy, make sure that you talk to a CPA or a financial professional before doing so that you know exactly what that gain or loss would signify to you.
Well, I think one thing really quick, Frank, is we also want to make sure that we don't do what's called a wash sale.
Correct.
Right. If I say, once again, I'll reference Apple since that was a stock we talked about earlier. We like Apple. but we just bought some and we have a loss, we sell it. We can't turn around necessarily right away and buy Apple again because we like it long term. And so what we have to do is we have to wait 30 days in order to get back into Apple to be able to capitalize on this tax loss harvesting. Mm-hmm. So, as Frank mentioned, reach out to a CPA. If you're not working with one, let us know. We can refer you to a number of different CPAs that can help you with this. But this is especially in volatile markets, this is an opportunity for a lot of individuals to start taking a look at and complementing with their retirement plan. Because this can help you if you have those losses, potentially when you get to retirement and you're still carrying those over, can help you in some of those other areas.
Correct.
So.
And let's see, I'm getting a couple questions here, Josh. So let's see. So this individual, he's asking, right, do I need to be 59 and a half in order to do a Roth conversion?
The Roth conversion can happen at any age. It doesn't matter if you're in your 20s, your 30s, 40s, 50s, or even if you're retired and you're not working anymore. So, with the Roth conversion, you can go through and do that at any point. The other general question that we get with Roth conversions is, do I need to do my entire account? No, you can do as much or as little as you want. And, the one thing that I want to make sure that people understand is the other big thing is to look at is from a tax situation, is it going to put you into that next bracket? So finding the right amount to do a conversion so that you're not paying more taxes than you really need to. And some of the strategies that we'll do is we'll spread it out over a number of years. We say, okay, we're going to do $100,000 out of your traditional IRA, but we're only going to do $15,000 a year until we get to that 100 grand because of somebody's current income. And so, there's no age limits, there's no age restrictions. The nice thing, and I don't know if we said this or not, you don't pay the 10% penalty because you're still moving it into another retirement account. So it's a great question.
Perfect. Next question is, and this is probably going to be our last question since we're running a little bit out of time. So can I consolidate my spouse's and my retirement account since you guys were talking about account consolidation?
So we need to remember what IRA stands for. It stands for individual retirement account. And so you and your wife or you and your significant other cannot have just one IRA between the two of you. Now, I think it's important, though, to also stress on this. You need to make sure you check your beneficiaries. We actually recently ran into somebody that thought that their spouse's IRAs were together, or their ex-spouse actually was together, but she was still listed as the beneficiary on his account. Mm-hmm. And if something were to happen to him, I don't think his new spouse would have been very happy because then that old, his ex-wife would have received
how many exes?
Right, exactly, would have received the money. And so IRA, once again, individual account, individual retirement account, both on the Roth and the traditional side, just like your 401k is in your name. It's not in both of you or your spouse's names. Another great question.
Fantastic. So how can we help you right now? How can Tidemark Financial help you right now? And let me try to go back to that slide.
I got it for you, Frank.
Perfect. Thank you, Josh. So basically what we can help you out with is perform the analysis of that current portfolio and walk you through the recommendations on your current investment accounts. So basically perform that Monte Carlo analysis, take a look at your retirement plan, see exactly where you're at, form that cash flow distribution analysis so you can take a look at it year over year and make sure that those goals and those decisions that you have taken for you and your family are going to be attainable, or at least trying to get them closer to being so. We can consolidate and implement a strategy and see how would your retirement look like and create that withdrawal strategy, taking into consideration those taxes that we talked about by doing the Roth conversions, tax loss harvesting, see how that is going to impact you. But as I mentioned at the beginning of my presentation, was really what's more important is having that financial plan first, so that we can take a look at the investment second and make sure that they're two working together. A lot of people reach out to us and say, hey, Frank, here's $100,000 to make me some money, right? Really, this is not how we work. the focus of how we work is saying, what's the purpose of those $100,000? What's the time frame? What's your risk tolerance? We try to find all these different things for you and your family so that we can make sure that we're pairing you up with the investments that are going to follow that financial plan. And lastly, we can give you a second opinion on what you currently have right now. You might be doing things pretty okay, pretty right. So we would just give you that second opinion and maybe just fine tweak a couple of the things that you have created for yourself. Lastly, as we mentioned, we want to give you thanks for staying through the presentation. And as a big thank you, Josh and I are opening up our calendar during the next 2 weeks, and we're going to be performing complementary retirement analysis. We're going to be doing that Monte Carlo simulation for you, along with performing a stress test of your current investments, just to see what level of risk are you currently taking and seeing if your retirement plan is going to be sustainable. So make sure that you're one of the first 15 people to send us an email at info@tidemarkfp.com. And the subject, simply put, retirement consultation, and just let us know that you were here at this webinar. And we just want to give you a big thanks. If you're interested for future webinars, or would you like a copy of this to sign out to as well, send us an email to as well and say, I'm interested in future webinars, or just give us your comments on how we did.
Yep. We also have newsletters. And then, like, as I mentioned, everybody that is here today will send our ebook on how you can master the 401k, which gives you a little bit of background about the 401k, the history, what are different things that you can do, and how can all those other areas go through. So once again, we want to thank everybody for joining us. Here's our contact info. Once again, check out our website, tidemarkfp.com. And we look forward to talking to everybody soon. Thanks for joining us today.
Thank you, guys.